letting a few folks in slowly but surely, gearing up for 2026. I'm getting really excited. We've had a really strong and successful 2025. A lot of big things for the multifamily industry, a lot of things in the news, a lot of building of systems and processes in 2025. We're going to recap some of those things that we were able to accomplish this year. I also have a special treat. I have a 2026 goal setting worksheet that I'm going to share in the chat right now. And I'd love to be able to have you guys jump in, download your version of the sheet. Let's see, share. All right. Copy link. If you can download the sheet, if you'd like, it is a free tool. It's very, very basic, but basic things are really, valuable, I generally find. Um, Something so simple as literally just a to-do list can really change the whole scope of your life. So I created this. It's essentially a goal setting worksheet for your 2026. There's a link in the chat. So jump in, download it, print it off, fill out your 2026 goals. And yeah, I'd love to be able to hear from everybody on how their goal setting went, so on and so forth. So yeah, let's gear up. Keep letting more folks into the room, and then we'll start the webinar here in just a moment. Anybody have any successes or failures, setbacks, or anything they'd like to share before we get started? No, I had a pretty big set. I had it on the same day this last Friday. I had a really big success, and then also an immediate setback. We at this one property we have in Hot Springs, Arkansas, we tripled our water bill. Water bill tripled in the last 90 days. It's been absolutely insane. It went from 5,000 a month to 15,000 a month. Um, Ended up having to travel to the property, hiring a leak detection company. We did end up finding the leak after 2 full days of searching and spending like $2,000 and walking 100% of the apartments. We did manage to find a pinhole leak. I'm talking about literally the tip of your pin size hole in one of my pipes that was costing us $10,000 a month. But immediate setback. Then our boiler system just blew up because the water shut down and nobody turned it off. So then the boiler shut down. So, or just blew up on us. It was absolutely horrible. So success and failure in the same day. So yeah, at the
Any
end of the day,
luck getting relief from the water company for that? Do they give you any reprieve from that bill?
we had the paperwork's being submitted as we speak with the pipe and the leak that we found, so on and so forth. So, yes, I'm hoping we will be getting some sort of a credit discount, whatever, for that water leak. And it was caused, I think it's called electrolysis, where it causes pinhole leaks in copper pipes. So,
Hmm.
yeah, it I'm glad we found it. And we did have a setback with one of the boilers, but at the end of the day, we'll get that replaced. And yeah, uh, no, just at the end of the day, we had a success and a failure. So 2025 recap, 2026 game plan. If you don't have your 2026 game plan written out, the link to a Google Doc that I created with a literally very simple four-step. Here, I have another one as well that is fail-proof. This is one I created as well later. All right, either one, whichever one resonates best with you, jump in, download a copy of the Fail Proof Your 2026 goals, and use that as an opportunity to write them out, write out your goals. So we'll go ahead and kick it off. We're 6 minutes into the webinar. I'm going to make sure we are recording. We are still recording. All right. Welcome. My name is Lee Fjord, and I'm the founder of Make It Happen Multifamily, as well as Green Forest Capital, my multifamily real estate syndication company. And this evening, we are here to discuss 2026 recaps. This is an interactive environment. If you have your, 2025 successes or, whatever that you'd like to discuss or even setbacks, love to cover that in the webinar live right here with the whole group. So if you have questions, successes, or want to just sit down and write your goals out, I did just provide the sheet. So, um, 2025 was a huge year for Green Forest Capital. We took our wide range of geographic focus in searching for properties and narrowed that down to a much smaller geographic area, as well as established a vertically integrated property management company. It's been a very big year of creating systems and setting strategic goals. So yeah, and reaching them. And in 2026, we're setting our goals already, making big plans. If you don't, let's see. Setting goals is the first step in turning the invisible into the visible, says Tony Robbins. I love Tony Robbins. And if you don't know where you're going, or if you don't have your objectives and your goals clearly written out, then you don't even know where you're going. You're just driving down the highway, going wherever you want to go, and don't know where you're going. So, um, who am I? Well, my name is Lee. I started out as a property manager in 2012. I now have owned 1,100 apartments, a little over 1,100 apartments. And my big objective is to be able to help others, help investors grow their own portfolio or invest passively as well, because I am a syndicator and I believe in the power of partnership. The more people rowing the boat in the same direction, the better. So this QR code will be on the screen pretty regularly. But if you have an opportunity to jump in there, book a call with me just to get to know each other better. That's my goal. That's why I do these webinars, is I want to get in and on phone calls with you so that I can find out how I can best help you. All right, let's keep it rolling. All right. So what do? I do multifamily real estate syndications, and how a basic syndication works is you take a property that's owned by an LLC, and you have two different types of owners. You have the owners who are actively involved in the active, like, property management, asset management, signing on the loan, doing all of the hard work of owning real estate. And then you have the passive partners as well, who provide the capital needed in order to acquire the property. And they have a passive opportunity to be able to invest in real estate without having to be a landlord, without having to show up to a ton of meetings and make sure that the success of a multi-million dollar business is on the shoulders of someone who should have that responsibility, the people who've done it before. So, all right, big wins of the year for Green Forest Capital. We established our vertically integrated property management company. We're now vertically integrated, managing two properties that we now, whether we have one we acquired last year and another we acquired this year. We have constantly been monitoring all of our projects and met every single one of our renovation timelines in 2025. Every single one of our projects, not a single one has like gone off the hill or been something we couldn't accomplish on time. We entered a new market. We bought our first property in Kansas City, with the Kansas City MSA. So we bought 64 units in Warrensburg, Missouri, home of the what is it? It's the oh my gosh, it's like the Donkeys or something. That University of Central Missouri, their mascot is a donkey. Anyways, but this is the property here behind us, entered a new market, and that helped also kind of narrow our buy box as well. We also had a huge success earlier this year where we sold the very first syndication I ever did. So the very first syndication I ever bought back in 2020 was a 76 unit apartment building right here in St. Louis. It took us 5 years. Literally, we closed on it 8 days 5 years and 8 days after we bought the property. Yes, I did have to ask my lender for the extension on my loan because the loan would have expired on the last day, the fifth, the fifth of the fifth year. But they gave me the extension and all was good. But we managed to get a property, yet another property. This will be the fourth deal. Yeah, fourth deal that has gone full cycle. All the investors were paid out, and now we're just down to closing out the general partnership ownership team, which we hope to be able to do this calendar year. So winding down a deal, which has created an opportunity to be able to go out and now redeploy that capital into new opportunities. So that has built investor trust. I focused on building and not only selling deals and hitting our markets and going to new communities. I've focused time and effort on building investors' trust in us, in my team and myself, and maintaining that level of communication with them. Yeah, these webinars are a part of that overall trust, is having an opportunity constantly for those investors to get to know me and my team a little bit better. So strategic pivots. We have avoided over leveraged deals, and that has really helped reduce the risk on our deals. We've narrowed our focus down to only buying 1990s or newer properties. We've narrowed focus on geography, now only looking in Missouri, Arkansas, Kansas, Oklahoma, and not all of Texas, because Texas is as big as all those other four states combined. But we're talking about Northeast Texas, basically Dallas and Northeast. And the big flag, the big thing that we did this year is established our vertically integrated property management company, Origin Property Management, and Origin will be managing and self-managing the majority of the properties going forward, ideally, as long as they fit within the Origin's capability. So big pivots. Historically, in the past, I was a big believer in utilizing third-party management. And I still am in some cases. And in some instances, for a lot of operators, it's a great idea for them to utilize third-party management because they don't have the time. Maybe this isn't their full-time thing. Maybe it's way far outside of their geographic location and they need someone there to be able to deploy to the property or make sure that the property's operating successfully. So everybody has their way of doing it. But I will say that I am finding that our properties, I'm not sure how, because we're still, assessing a management fee, but yet our vertically integrated properties are consistently operating at around 10% of total operating income in lower expenses, if that makes sense. So normally if a property is operating at like 50% expense ratio, somehow magically, because we're vertically integrated, we are operating those properties at more like 40 or 42% expense ratio. That includes still having a management fee in there. So don't ask me how or why. It's like voodoo magic that magically everything's 10% more expensive when you hire third-party management. But I think it really has to do with deep down inside, when those management companies are making the small decisions on a daily basis, when they're spending somebody else's money, they intrinsically think about somebody else, or they don't think about the bottom line when they're spending their money versus when you're spending your own money. Like, I don't know, I'm fighting a 3-year security system contract that one of my property managers put in place a year ago at one of my properties that I never even knew about. Didn't even approve it. I don't think we need security system at this property. But yet the property manager thought it was a good idea, so she went and signed us up for it. And guess what? She doesn't even work for us anymore. I never would have said, yes, sign up a 3-year contract for a security system for $130 a month or whatever it is. So Yeah, people just tend to you spend your own money differently when you are vertically integrated. So, yeah. All right, the market ahead and big things that we're focused on in 2026. We're already starting to see rate cuts, and I think the next meeting is like maybe tomorrow or the next day off the top of my head. But Fed is cutting rates. They've already done two off the top of my head. Don't quote me on that, but I believe it's been two rate cuts, and I believe we're expecting a third in the next few days, and probably another 25 basis points. And that is expected to continue into 2026. Lower rates it creates cheaper cost of capital and is going to create rising demand. And I think this is an industry, multifamily wide, at least industry agreed upon, understanding. And in 2026, rates are going down and demand is going to rise. And I actually also believe that supply of inventory is going to drastically increase. I focus a lot of my time and probably a third of my time is focused solely on finding new opportunities and maintaining relationships with the brokers that sell the types of properties that we buy in our markets. And every day I'm having conversation with brokers and it's like, hey, what do we got? What do we got coming up? And I will say this. Each one of them is saying, we have X number of deals coming in the first quarter of 2026. One broker was like, I've got over 1,500 apartments that we've signed up already with owners that will be listed in Q1 of 2026. And that's more than what they sold all last year. So inventory is going to be readily available. And they're going to be available for those people who are ready for it. Luck is the perfect intersection of timing and preparedness, or whatever the quote specifically is. So if you are prepared, and the timing is correct, you will find luck. If you're missing one of those other two things, you're probably not going to find it. So we are gearing up for a very strong 2026, and we're looking to do multiple deals in 2026. And yeah, I think that passive investors can benefit very well from creating relationships now and understanding what an operator's doing business with an operator is like today, because then they're not trying to create new relationships. They're not trying to understand how a business or a syndication works, what the paperwork looks like, what returns might look like for a given deal, maybe when it happens. Let's get that all out of the way ahead of time. So then you can just focus on the investment opportunity when that opportunity presents itself. All right, we're doubling down. We are focused. We are focused on a specific geographic area: Missouri, Kansas, Oklahoma, Arkansas, and Texas. That's it. We're not looking at any deals in any other places. Um, and why? Because we know the people, we know the brokers, we know the insurance folks, we know how to get through the local municipalities to do things like permits. We know the local operators for property management companies. We know those areas very well. And that's why we're just doubling down, focusing on our core geographic area. And it also makes it easier to operate because for me, that's about a 6 hour drive to anyone, or maybe 8 hour drive to any one of those locations. It makes it much easier to execute when you're vertically integrated. So we're going to be lean and mean and focused on our geographic area. Yeah. And focusing and with the vertically integrated platform and the focus on our geographic area, we're going to be able to have control over the expenses that are optional, like security systems, like $120 a month security systems for, to make sure that the maintenance man isn't smoking cigarettes in the maintenance man closet. Honestly, I don't care enough. You can go get a Nest for that, and that's like $10 a month, not $120 a month. So returns and investment strategies that are built on control, things that are in our control and taking control of them as opposed to market speculation, appreciation, and you actually get into. Yeah. So that's our focus, doubling down on the West Midwest. Yeah. We are, sure. All right. We are focusing on newer properties. We purchased in the last year, in 2025, we bought a 2004 constructed property with 2024 roofs. And I'll tell you, I love it. I would buy a smaller property, like, 50, 80 units that is 2004 construction over a 140 unit that was built in the 1970s any day. I would much rather have that. Your all of your expenses are lower and your rents are higher. You'll attract a better quality tenant and it won't cost you as much to maintain it. It won't cost you as much to renovate those apartments or do the turnover, which is a huge, huge line item. Focusing on cash flow, durability, and tenant demand. We want to have properties that stay full, and when we buy them, they will be full. So we're no longer buying properties that need 100% tenant relocation. Let's just call it tenant relocation. It's essentially kicking everybody out. We're no longer buying any of those because it is you always dip lower on occupancy than you plan for. And stronger management equals stronger returns. Yeah. And a property that we would be buying is a property just like this one, which this is actually Arbor Ridge. We bought that one back in 2021. All right. What are we going to also be doing in 2026? We're going to be selling one of our properties. We're going to be selling the Higdon Ferry apartments that we bought back in 2021. Or no, 22. 22 we bought Higdon Ferry. So 2022 we bought Higdon Ferry. 2026 we're going to sell Higdon Ferry. I was recently at that property fixing a water leak and met with a broker. We sat down and talked about the three things that we need to do to be able to get this thing ready to go and at the number that I want to sell for, which is, let's just call it profit. Everybody makes a profit and hits the numbers that we planned for, if not better. And the first one was fix the water leak. Done. Next, 90 for 90. We hit 91. We're at 97% occupied as it stands today. And landscaping. Some of these bushes out of here, the landscaping on the front of the property are just not that. Some of them are dying and they're kind of poorly, trimmed or whatever. So the idea is just to go in and sweep that clean and put in nice little new bushes and, create some curb appeal. So those are my three big rocks that I've written on my whiteboard right here next to me that are going to tell me what do I need to focus on in order to get this property sold in, let's call it March of 2026. We are also projecting 2 refinances on properties in 2026. That is going to return all of the original capital back to our partners. That's my favorite type of deal to do. Is a deal where you buy it, you cash flow for the first couple years, you increase the value by decreasing expenses and increasing income and executing the value-add business plan, and then you hit the refi button and you return 100% of the original capital back to the partners. So then you've de-risked the capital side of the deal, or at least the owner, the equity capital of the side, and then we just keep it for the long run. We hold on to the deal for the long run thereafter, and the game plan is just to keep it for, usually we do a 10-year hold if we're doing a refinance into the deal. So I have 2 big refinances coming up in 2026 that I'm really looking forward to getting my partners back all their original capital. And ideally take that and use that to go buy 2, only 2. I'm limiting myself to 2 deals in 2027 or 2026. I want to buy 2, good sized deals as far as syndications go. I have it right here. It's going to be very similar to what we picked up very recently this last year. Call it like a $7 to $10 million deal. I'm not looking to go buy a $27 million deal that's a C-class 1970s property in, wherever, Cleveland. We're very focused. We know exactly what we want to buy. And we're expanding into a new asset class. So with this geographic focus, we're able to focus in at, or we're able to expand in one way. Only one way we're expanding, and that's into a new asset class. And I'm really excited about it because I've dedicated years of study and time into researching the industry and determining and learning how to underwrite it, surrounding myself with operators. And now I feel comfortable moving into self storage. Why? Why self storage? Well, it's diverse. It's a way to be able to diversify and give the investors and myself an opportunity to buy real estate that's similar to what we're already buying. Operating it is not dissimilar. It's not like going from multifamily to development. Like that's a whole nother ball game, ball of wax. Or multifamily to I don't know, big box industrial, Amazon stores or whatever. We're going to be buying these deals in markets where we're already established because I don't want to go also have to reestablish a new presence in a new marketplace. I want to buy them in areas where I'm already operating and leverage the teams that I have there locally and the subcontractors and maintenance men and whatever to be able to own and manage those properties. So synergizing the existing team, the existing systems, and the existing partners and investors to be able to go buy into a new asset class. Yeah. Why also self-storage? It is an operating business, though. If anybody tells you storage is passive, they're crazy. It's much less passive than multifamily. Historically, storage, like a good example is, they usually have 150% turnover every year. So 100%, 150% turnover. So you are constantly having to release your apartment, or well, your apartments, your storage lockers constantly, just to maintain occupancy. It's an actual operating business. But in comparison to multifamily, it does have lower operating expenses, most specifically things like maintenance, if for, pretty obvious reasons, as opposed to having drywall and plumbing systems and electric systems and individual water heaters and all of those things. All you have is a single box, and maybe if you have heating and cooling, or you have like temperature control, then you have one system for the entire build, opposed to, into a new scalable asset in the same markets where we're already operating. That's how we're going to grow in 2026. What does that mean for investors? For my investors, we're going to have more opportunities to invest. We're going to have multiple multifamily deals and ideally at least one self-storage deal. Continuing our stability operations. Operations is so key. That is just the most important thing. What happens on the day to day at your properties or the properties being operated by your sponsor is extremely important. That's the most important thing of all. A bad operator can make a great deal bad. Yeah. And a good operator can make a bad deal good. They really can. Yeah, operational excellence. So, what do people do? What's the goal here? It's join the investor list. Let's do a strategy call. Let's stay ahead of the curve so we can have conversations about like what kind of deals we're looking at buying. How can we partner together? So on and so forth. Question.
The so you guys are looking to acquire, just recapping here. So get two deals in 2026 between 7 to 10 million, 50 plus units, 1990 or newer in Missouri, Kansas, Arkansas, Oklahoma, and Northeast Texas.
That's exactly the case.
Got it. Origin, is Origin managing properties that you don't own currently, or are they
Nope.
currently and do you foresee that in the future, or are they only going to be vertically integrated within your company or within your properties?
Tossed around the idea of doing third-party management, but as of right now, it's solely for the focus of making sure that the properties that we own are operating efficiently. and successfully. There's also a lot of like licensing law in a given state. You have to be, and you charge a fee for it. You have to be licensed in that state. I am licensed in Missouri, and Florida. But also, I think that really the goal isn't to make a 6 or 10% management fee. The goal is to have everyone truly on the same boat and rowing in the same direction. That makes sense.
Yeah, absolutely. You mentioned brokers that you've been broker or brokers you've been in communication with say they've got a lot of deal flow lined up for 2026. Is that in any particular market, or is that all of these markets that you're looking in, or kind of where out of those that you're looking in, which ones excite you the most, and is it due to that deal flow, or why? Why?
It's all to answer your question, it's all brokers. Every broker I'm talking to is very excited about 2026. They had their worst year in history, like in 2024. 2024, if you were a broker and you survived, man, you are strong and have thick skin and probably had a lot of money set aside, from prior years of success. Because
Yeah.
2024 was a drought. Not very many deals got done in 2024. Uh, Rates were like crazy. It was insane how high rates got there for a while. 2025, it's kind of like from my interpretation, it's a culling. There's a lot of opportunities out there that are being sold because they have to be sold. Debts come due, the operator went bust, there's a divorce, something like that. Owners who have good properties and didn't have debt coming due, kind of holding back and have been holding back for, better times. I think it's going to be a mix of those people who are selling at lower interest rates and the people who are just barely holding on right now, who are going to be like, okay, now I can sell. And they might make a little bit of a profit, or at least they might just be able to break even, some of them.
Right. All right.
Yeah.
I think he bugged out.
Okay. And I had a great question too. Okay.
You know what? I think his internet's out. Maybe let's just give him a second here to get back online.
Yeah,
Yeah,
probably a good idea.
Can all of you hear me?
I can hear you. I can hear you, Sam.
All right. Since he's offline, I'll give a little 2 cents here of my. Hey, Lee, you're back on.
I'm back. Sorry,
Hmm.
I still house hack. I'm house hacking a duplex, and I think my tenant downstairs or my guest downstairs started watching Netflix or something. But go ahead.
One of the gentlemen
Um,
had a question.
mhm.
Yes,
So
Lee. This is Gabe. I was curious at what assumptions are most new investors commonly optimistic about in their first multifamily deals?
I would say other income is a big red flag. If a new person in the industry believes that they can rent covered parking spaces, or they can designated parking spaces, or washer dryers, or magically you're going to be making this much more money on other income that others aren't. I see that all the time where they're like, oh, we're just going to do this and it'll be like 80 units and we're going to get, $40 a month for washer dryer rent. It doesn't actually work that way.
Okay, so
I have,
supplemental income. I got you.
yeah,
Thank you.
that and rent growth. And vacancy. They underestimate the amount of vacancy they're actually going to have when they project like high rent growth.
Good. Yeah, thank you.
The other one would be like marketing. Yeah. Especially when you're in a lease up, you have certain like credits or discounts or whatever. Those count as a marketing expense in my mind.
Hey, Lise, this is Ross. Can you hear me okay? All right.
Yeah, I
Having
can hear
said
you.
that, oh, great. Having said that, what would be a good focus for new there's a new operators in this field? Because one thing that we all try to I try to focus on would be the value add. Something that I can was that something that will increase what was that? The income in there, as well as the rent increase. Depending on the analysis. What would be a good focus that you can suggest for us new operators in this field?
Let's see. I would say know how you can bring the most value, whether that's, mm, like deal flow underwriting or operations, and then making sure that the people on your team that there's not a lot of overlap. You run into a lot of teams and operators where you have a lot of overlap, where you'll have three people doing the same job, three people who are really good at that thing. And then they're trying to figure out how to fairly divvy up the ownership and the roles and responsibilities. And it gets hard. But yeah, focus on the thing that you do best.
Appreciate that, Lee.
Yeah.
Can I jump in, Lee? Can you hear me, Lee?
Yes, sir. Always.
Your face not moving. I'm
Yep.
sorry.
I hear you.
Your internet's a little slow on your
Go ahead.
end.
Top of the share. Yeah.
Can you hear me okay?
Yes, I can. Go ahead.
For those of you that haven't been involved in deals and want to step involved in deals and you've got a little money, the best way to learn is maybe get involved as a limited partner. And I like to say I've been involved in, I want to say, is it 5 deals with you, Lee? I think
That sounds
so.
yeah, that sounds about right.
Park Hills, Arrow, Avenue, Bowman,
Mate, Bowman,
Lawrenceburg.
5.
Look at
Yeah.
that.
Yeah.
And I have to say, every deal is a little bit different, and you really want to tie yourself to a person that really knows what they're doing. Lee does. He's been around the corner several times, and if you haven't been involved in any, mid-sized to large um, syndications and or joint ventures, and you want to get involved and want to learn, I'd say, dip your toe in the water first, and Lee's got a deal that you want to jump in. I'd say do that. That's the best way to learn. I mean, that's just my opinion, Lee. Um, and you'll see
Yeah.
all the workings from the top down. Not every deal's the same, and not every deal has the same underwritings. Not that every deal has the same lenders. Everything is different. Every deal we've been on has been different. Um, and I think you've done a great job as a managing partner, to be honest with you. So the team that's on here right now, either you're experienced or not experienced, and you want to jump in, I would recommend jumping in with Lee on even a small amount of money, and you'll really learn because that's how you get started on the smaller deals. And Lee had mentioned earlier too, don't jump in on those $20 million deals. Get started small on something you want to do, and then grow from there. That's just my opinion.
We also, I'm a little bit different than a lot of other operators where like I'll meet my partners, my passive partners at the property, give them the tour. Like Sam has been on site, like said, "Hey, I'm gonna come to St. Louis. I'm happen to be passing through. Can you meet me at the property?" I'm like, "Yes." Or I've even scheduled special trips just to go spend time with my partners and at the property or to run through the details of the operations. It's surprising how few of the limited partners actually take advantage of that, where they have unlimited access to me. They reach out and say, "Hey, I'd like to run through show me how we're doing on occupancy. What's your strategy on leasing? What's this?" And I'm an open book, always willing to jump on and talk and rap and listen to and hear new ideas all the time. So yeah, if I could go back as opposed to doing my very first like doing like smaller deals on my own, I would be in a much better place had I just like passively invested and found somebody that I could hang out with that was doing what I wanted to be doing 10 years from now as opposed to doing what I could do then. That makes sense.
You can make money on the smaller deals. You don't need to be on these huge deals. I think the larger deals are riskier, in my opinion. I don't know, just from what I've seen so far.
Yeah, my favorite deals are my like newer properties that are smaller. You know, Like this Warrensburg deal that we just bought, we raised $2.5 million on that deal, and it is 94% occupied. It's been we have zero work orders, like literally zero outstanding work orders on a 64 unit property. Um, those are great properties. And we have a plan to do a refi and roll on that one. I think it'll be a great, great property for the long term.
That deal is humming. It really is. It's a beautiful piece of property right across the street from the baseball stadium, from the University of Missouri. And by the way, it's Mo the Mule, Lee.
Mule, that's
Yeah,
Mule.
Mo the Mule. And also Warrensburg is the home to of the B2 Stealth. That's when we bombed Iraq or so this last couple year or two. That's where
Yep.
the military base is right there, and it really, I think we've got military people living in our apartment complex too.
Oh yeah, we do. Oh yeah. So here, it's this deal. I'll get this out of the way.
And
Yeah.
there's student housing on both sides of our complex. And I don't think we have a lot of students in that
No,
building. Mostly
not really.
but it's a beautiful complex.
Mhm. Yeah, it's got A-class properties right nearby, super clean. I mean, yeah, I really love this location. Your walking distance to the college itself. It's not in like downtown St. Louis or Kansas City. It's just slow and steady wins the race. We're talking about a town of 30,000 people, an hour west of, or yeah, an hour east of Kansas City. So that's, come on. Well, anyways, I'll stop sharing. Yeah, I'll show you where it is. Main Street.
I'd like to add something too while you're looking for the map there, is I'm involved in
Yeah.
other syndications with other managers and other large companies that put together these big deals. The majority of their financing has been bridge loans. And every deal that there's been a bridge loan, the deals are failing because all of a sudden rates are starting to come up and they're starting to adjust and the rents aren't there and they can't make the payment. And these deals are failing. I don't think, Lee, you've done any bridge loans. Mostly has been
Never.
agency and bank loans. And
Yeah.
if you get a good underwriter, or if you're underwriting the deal, be very conservative in these times. I don't care if the rates are low or not, but if you think it's going to cost you $1,000 for insurance, you better figure 50% more. Insurance always kills you on these deals, and maintenance. So your underwriting's got to be right on. A lot of these other syndicators I've worked with, their underwriting is not on, and when you get about 2 years into the deal, it starts to fail. So Lee does a very good job of underwriting and being very conservative on these projects. I'm sorry, I didn't come on here to sell you, but
I appreciate it. I do. Well, if anybody knows, I think Sam's done more deals with me than most anybody. I appreciate that he's been so supportive always along the way. Yeah. Anybody else have any questions? Yeah. Any way I can
I
help
do,
you? Any
Lee.
big goals for 2026? Yeah, Shelley.
Hey, on your properties, when you refi out, do your investors stay in the properties? You do the infinity return, is what I would call it, type thing.
That's the plan.
I,
Literally.
I'm
I,
on one right now with Lee on one of my first deals with him back in 21. That we refied out this past year. Is that correct? Park Hills?
yep. Right. We had planned for 36 months into the deal. Uh, and we refi and returned the money to the investors on month 40. So we were a little late. Oh, did I lose you?
You're back on.
Gosh, I think I need to upgrade my. There we go. Yes, we refied right on time. We originally planned for a 36-month refinance and return to member capital, and we did it in month 40. But yeah, all the original invested capital back to the partners, and everybody's still in the deal. And even though we levered up, we increased the amount of debt. We're still doing distributions. Literally didn't miss a quarterly distribution yet, even after sending all the money back out. Yeah. And those smaller, deals do work well. We usually do a 506B on one of those. So the best plan is if you're interested in, even not as a limited partner, but if you are potentially, we should get to know each other ahead of time and we should book a call and just get to know each other as a whole. I'll be happy to walk through. I have a 3-step, 3-phone call process to do that. It usually involves first just getting to know each other a little bit. Then I go into the detail of several of the projects that we've done before in the past. And then I learn about your investing capacity. And then we officially have a substantial relationship. And then when I have an opportunity that comes up, the people who I've the established relationship are the first ones I reach out to for any deal. And then if we're doing a 506B, it gives the opportunity for anybody who may not be credited to jump in as well. And you can find that link right here to book a call with me. This is literally just a QR code that takes you to my Calendly. You can also, schedule a call on my website, greenforestcapital.com. Literally, there's like the same link to book a call there. And I'd love to meet you. I'd love to have a conversation. My whole goal of these webinars is to meet new friends, new potential partners, find ways we can collaborate, do deals together. Yeah, all along the way. So please do book a call and we can get to know each other and build that substantial relationship that we just talked about. Well, if there's not any other questions, we can draw this month's webinar to a close. We do these on every second Tuesday of the month. I will have another one booked for the next second Tuesday of the month of January. I look forward to seeing everybody for that webinar. And I look forward to having some phone calls and meeting with you guys over the holidays if you have an opportunity to book a chat.
Hey Lee,
Sounds like a
before you
plan,
go,
Ray.
Thank
sorry
you,
to hold you
Lee.
guys up. Shameless plug on
No,
your
I'll,
tours and pours. You gotta tell people about the tours and pours. I'm
I'll
gonna miss this next one coming up and going to
thank you.
Mexico with the family.
Thank you for reminding me. Yes, we're doing every month. We for Make It Happen Multifamily do our live events here in St. Louis. It's on the second Thursday of every month. So in 2 days, we're going to be doing our annual Christmas celebration. So if you're in St. Louis or able to be in St. Louis, I would love to have you there. Schlafly Tap Room right by the soccer stadium at 6. We're going to have a panel of 5 owners in addition to myself on the stage. These are people who, last I checked, his portfolio was like $780 million. So has almost $1 billion of assets under management. So we're gonna have an awesome panel of owners up there on the stage. We'll probably have, you know, I mean, it's well north of $1 billion worth of real estate owned in that room. Might even be willing to venture that it's almost 2 billion. So if you're able to be there, Schlafly Tap Room, 6 p.m. On Thursday this week. All
Thank you,
right.
Lee.
Well, we'll call this
Appreciate it.
one
Thank you.
closed. My pleasure. Always, you know how to reach me, and I'll see you again on next month's Make It Happen Multifamily webinar.
All right.
Bye, everyone.